On June 9th, 2018, while most of the world slept through an ordinary Saturday morning, a tiny European nation carried out one of the most important financial experiments of the 21st century, an experiment almost no one noticed, yet one that revealed the future for all modern banking systems. It was not Cyprus. It was not Greece. It was a quiet, carefully managed resolution weekend in a country whose name rarely makes global headlines. A mid-sized regional bank long struggling under the weight of bad loans and interest rate pressure finally buckled. Regulators had known for months the institution was dying. They had also known something else: there would be no bailout. Not anymore. Instead, they would test a different model, one recommended by the Financial Stability Board, endorsed by the G20, and quietly written into the banking laws of almost every developed country, the bail-in. At 3:14 a.m., account access was shut off. Cards stopped working, transfers stalled, mobile apps displayed maintenance errors. By sunrise, the central bank had seized control of the institution, and when the bank reopened the following Tuesday morning, something extraordinary had happened. Large deposits, those above the national insurance threshold, were reduced by a precise percentage. Not stolen, not lost. Legally confiscated. Depositors did not wake up to empty accounts. Instead, they woke up to adjusted balances, a bland phrase masking a brutal reality. What had once been their savings was now partially converted into bank equity shares of a failing institution they never asked to own. The government released a statement calling the operation a necessary step to ensure national financial stability. International observers praised the speed, the efficiency, the minimal public backlash. And behind closed doors, regulators across Europe, North America, and Asia studied the weekend carefully. The test had worked. No riots, no bank runs, no taxpayer bailout. Depositors absorbed the losses the bank survived, and the financial system moved on. That weekend became a template, a quiet proof of concept for a global banking regime designed after 2008, but never openly discussed. A regime in which governments no longer rescue failing banks with public money. They rescue them with your money. Most people never heard about the event. Fewer understood what it meant. But those who did realized something unsettling. The modern financial world had crossed a line. The question was no longer if depositors would be used to stabilize future bank failures. It was when. And that when is approaching faster than anyone expects. Most people think they understand how banks work, but almost no one understands the one detail that matters most during a crisis. When you deposit money in a bank legally, it stops being your money. It becomes the bank's money, and you become an unsecured creditor at the very bottom of the repayment hierarchy if the institution fails. This single fact transforms the meaning of a bail-in entirely. Everyone knows the word bailout, the dramatic rescues of 2008, when governments poured hundreds of billions into collapsing institutions to prevent a complete economic meltdown. Taxpayers funded those rescues. Public money saved private banks. The backlash was immense, the political cost severe, and the anger long-lasting. Policymakers heard the message. They promised never again. But financial crises do not disappear just because the public dislikes them, and governments cannot allow their banking system to collapse. So they designed a new solution, one that would require no taxpayer funds, no congressional vote, and no public debate: the bail-in. In a bail-in, the government does not give money to a failing bank. The bank is recapitalized internally by its own creditors. And as shocking as it sounds, the largest pool of unsecured creditors in any banking system is depositors themselves. When a bank becomes insolvent, its assets worth less than its liabilities. The resolution authority steps in, freezes accounts, and forces losses onto those creditors. That means deposits above the insured threshold are either written down, partially confiscated, or converted into equity of the failing bank. You wake up one morning and discover a portion of your savings is gone or transformed into stock you never asked for. This is not theft. It is not a hack. It is a legally sanctioned restructuring method adopted by the European Union, the United Kingdom, Canada, Australia, New Zealand, and yes, the United States. Most people have never heard of it because it is designed to happen silently, quickly, over a single weekend before depositors can react. The bail-in is not a conspiracy theory. It is simply the modern mechanism for dealing with bank failure in a world drowning in debt, exhausted by bailouts, and searching for a politically acceptable way to let banks survive at the expense of depositors. Once you understand this, everything that follows becomes clear. If you want to understand the future of banking, you don't need predictions, you need precedent. Bail-ins are not theoretical, not experimental, and not rare. They have already happened repeatedly across the world, each time following the same cold pattern: accounts frozen, deposits restructured, and ordinary people forced to absorb losses they never created. Consider Iceland in 2008. When its massive banking sector collapsed almost overnight, the government refused to save the institutions that had ballooned far beyond the size of the national economy. Domestic deposits under the insurance limit were protected, but anything above that threshold was trapped inside failed banks for years. Even after partial recoveries, depositors lost around 10% and, more importantly, lost access to their money when they needed it most. In Argentina in 2001, the corralito became a national nightmare. Banks froze accounts, limited withdrawals to a few $100s a week, and then forcibly converted U.S. dollar deposits into pesos at an artificial exchange rate. When the peso devalued by more than 70%, millions saw their life savings evaporate. It wasn't called a bail-in, but the mechanism was identical. Depositors paid for the system's failure. Italy faced its own reckoning in 2015 when several regional banks imploded. Thousands of ordinary Italians, many of them retirees, held subordinated debt and hybrid instruments sold to them as safe savings products. Overnight, they were classed as unsecured creditors and wiped out completely in a formal bail-in. Their life savings were converted to worthless equity. India offered another warning in 2020 when PMC Bank collapsed. Regulators froze accounts, restricting withdrawals to just a few $100s at a time. Some depositors were locked out of their money for more than a year. While not labeled a bail-in, it demonstrated the same reality. When a bank fails, depositors become collateral damage. And then there is Lebanon in 2019, the most brutal modern example. Banks imposed de facto bail-ins by blocking transfers, capping withdrawals, and haircutting dollar deposits by 40 to 60%. There was no law, no announcement, no plan, just systemic collapse that forced banks to survive by sacrificing their customers. 5 countries, 5 crises, 5 outcomes identical, and structured depositors lost 10 to 75% of their money, often with no warning and no recourse. These are not anomalies. They are the blueprint. And the United States, contrary to popular belief, is not immune. It has simply not yet reached the moment when the mechanism must be activated. Most Americans believe their deposits are safe because the FDIC exists. They imagine a vault, a guarantee, a system so robust that failure is impossible. But the truth is far more complex and far more unsettling. Since 2010, the United States has had a fully developed, legally binding bail-in mechanism written directly into federal law, designed specifically to avoid taxpayer-funded bailouts. The law is not obscure. It is not hidden. It is not ambiguous. It is Title II of the Dodd-Frank Wall Street Reform and Consumer Protection Act, and it gives the federal government extraordinary power over failing banks. The most important section is Orderly Liquidation Authority, which allows the FDIC to take control of a failing financial institution, freeze its accounts, override shareholder rights, and impose losses on creditors to stabilize the system. And remember, depositors are legally classified as unsecured creditors. That means your deposits above the insured threshold are fair game in a resolution. Under Section 210H, the FDIC can immediately create a bridge financial company, a temporary bank structure that receives insured deposits and essential operations. This preserves the illusion of continuity, but uninsured deposits do not automatically transfer. The FDIC has complete discretionary authority to leave them behind in the failed institution, write them down, or convert them into equity in the new bridge entity. In plain English, they can cut your balance, turn part of your savings into stock of a collapsed bank, or hold your money inaccessible until restructuring is complete. Section 210B specifies the priority of claims. Secured creditors are paid first. Administrative expenses next. Then senior debt. Depositors, unless fully insured, sit below those claims. If the bank's losses exceed its assets, uninsured depositors absorb the haircut. And Section 214 adds the most alarming power of all: the FDIC's actions are not subject to prior judicial review. Courts cannot block a resolution. Depositors cannot challenge the process beforehand. Everything happens behind closed doors over a weekend without public warning. In 2013, the FDIC and the Bank of England jointly published a paper describing how globally active banks would be resolved using single point of entry, a strategy that explicitly includes bailing in unsecured creditors, including large depositors. They used Cyprus as a reference model. The United States has also required every major bank, J.P. Morgan, Bank of America Wells, Fargo Citigroup, Goldman Sachs, to submit annual living wills, detailed resolution plans explaining how the FDIC would unwind them in a crisis. Every one of these plans includes mechanisms for imposing losses on depositors. The legal architecture is complete. The operational plans are written. The authorities have rehearsed the scenario. The only missing ingredient is to trigger a banking crisis large enough to activate the machinery. And given the pressures inside the system today, that moment may be much closer than anyone wants to admit. To understand why bail-ins are no longer an emergency tool, but the default solution for the next banking crisis, you must look at the structural realities of modern finance realities that leave governments with no other viable choice. The first reality is mathematical. The FDIC's deposit insurance fund holds roughly $128 billion, while the U.S. banking system contains more than $10.5 trillion in insured deposits. That means the FDIC can cover just over 1% of insured money. If even two mid-sized banks fail simultaneously, the insurance fund evaporates instantly. There is no conceivable way to insure the system at scale without either massive money printing or massive taxation, both politically impossible. The second reality is political. After the 2008 bailouts, public tolerance for taxpayer-funded rescues collapsed. Politicians learned that voting for a bailout was career suicide. No government today, especially in a polarized, debt-heavy America, will authorize hundreds of billions to save private banks. The outrage would be uncontrollable. Bailouts are no longer politically viable. The third reality is international coordination. In 2014, the G20 formally endorsed the Financial Stability Board's bail-in framework, declaring that unsecured creditors, including depositors, should be used to recapitalize failing banks. This global consensus means America cannot step outside the system. If Europe, Canada, the UK, Australia, and Asia all use bail-ins, the U.S. cannot revert to bailouts without destabilizing international financial flows. The fourth reality is structural fragility. The modern banking system is more leveraged, more interconnected, and more dependent on derivatives than at any point in history. A major bank failure today would not be a local event. It would spread instantly across markets. The only mechanism fast enough, large enough, and legally authorized to handle that cascade is the bail-in. The fifth reality is strategic design. Dodd-Frank was explicitly created to eliminate taxpayer bailouts. Every word of Title II was written With one outcome in mind, private creditors will absorb losses, not the government. And since depositors are the largest class of private creditors, they have become the primary shock absorbers of the system. Put these realities together, and the picture is unavoidable. In the next crisis, the bail-in is not a possibility. It is the only tool the government has left that is fast enough, legal enough, and politically survivable. The system has already chosen its path. All that remains is the moment when it must be activated. Every financial crisis begins with a spark, but the damage comes from the dry forest beneath it. Today, the U.S. banking system is sitting on several layers of structural risk, so large and so interconnected that any one of them could ignite a full-scale systemic event. The first and most immediate trigger is the commercial real estate implosion. Across major American cities, office buildings sit half empty, their values down 40 to 60% from pre-2020 levels. Yet banks still carry these loans at 2019 valuations, pretending the losses don't exist. More than $1.5 trillion in commercial real estate debt is coming due in the next 3 years, much of it tied to properties that cannot be refinanced at current interest rates. When these loans default, and they will, regional banks, which hold nearly 70% of all commercial real estate exposure, will absorb catastrophic losses. The second trigger is the hidden derivatives chain. U.S. banks collectively hold more than $200 trillion in notional derivatives instruments designed to hedge risk, but capable of amplifying losses when counterparties fail. A single major default can create a cascading effect, forcing banks to cover obligations they had assumed would be netted out. This is precisely what nearly destroyed the global system in 2008 when AIG couldn't pay its swaps. Today, the exposures are 5 times larger and the interconnectedness is deeper. The third trigger is duration mismatch on bank balance sheets. When interest rates surged from near zero to over 5%, the value of long-term bonds held by banks collapsed. Institutions are now sitting on hundreds of billions in unrealized losses. They can hide them as long as depositors stay calm. But the moment large withdrawals begin, banks are forced to sell bonds at a loss, exactly what destroyed Silicon Valley Bank in 2023. If this dynamic strikes multiple banks simultaneously, the losses will be too large to absorb. The fourth trigger is sovereign debt instability. With U.S. federal debt exceeding $37 trillion and interest payments surpassing $1.2 trillion a year, the government's own finances are under stress. If foreign buyers reduce their treasury purchases or the bond market demands higher yields, banks, which hold vast amounts of government debt, will face immediate mark-to-market losses. The fifth trigger is liquidity drain. Quantitative tightening has removed more than $1 trillion from the financial system, drying up market liquidity and increasing volatility. Stress in one market now spreads instantly to others. These triggers are not isolated, they reinforce each other. A commercial real estate collapse weakens banks. Weak banks trigger derivative stress. Derivative stress sparks liquidity panic. Liquidity panic forces bond sales. Bond sales create further losses. And when the spiral begins, the government will need a mechanism fast enough to stop the chain reaction. That mechanism is the bail-in. The fuse is already lit. The only uncertainty is which trigger reaches the flame first. A banking collapse does not begin with sirens or headlines. It begins quietly, invisibly, in the final hour before markets close on a Friday afternoon. Traders sense something is wrong. Credit spreads widen. Rumors circulate about a major institution facing a liquidity shortfall, but the public hears nothing. At 3:59 p.m., the bell rings, the screens go dark, and the countdown begins. By 6:40 p.m., the Treasury Secretary, the Federal Reserve Chair, and the FDIC leadership are on an emergency conference call. The failing bank has hours of liquidity left. A normal bankruptcy would trigger immediate contagion. A bailout is politically impossible. There is only one option: invoke resolution authority. At 1:00 a.m. Saturday morning, the order is signed. The bank is seized. Its executives are locked out of their systems. FDIC teams begin penetrating the institution's internal ledgers, mapping liabilities, categorizing deposits, and calculating the capital deficit. Debit cards stop working for technical maintenance. Wire transfers hang indefinitely. ATMs show temporarily unavailable. By sunrise, a full freeze is in place. Customers checking their banking apps see vague error messages. No specifics, no warnings, no explanation. Behind closed doors, FDIC analysts work at high speed. They examine the gap between assets and liabilities. They determine how much capital is needed to restore solvency. They measure uninsured deposits, everything above $250,000. Using the statutory formula, they compute the required haircut: 18%, 27%, 36%, whatever the balance sheet demands. Sunday afternoon, the restructuring blueprint is finalized. Insured deposits will be transferred to a new bridge bank. Uninsured deposits will be partially written down and partially converted into equity certificates. By Monday at 8:30 a.m., the public statement is released. The government congratulates itself on ensuring financial stability. They emphasize that insured deposits are safe. They avoid mentioning what happened to the rest. When account holders finally regain access to their banking apps, they see a new balance, a smaller one. No warning, no appeal, no reversal. A weekend has passed, and their financial lives have been rewritten. This is not speculation. This is the exact procedural sequence already rehearsed in the United States, and once it starts, there is no way to stop it. When a bail-in is triggered, losses do not fall evenly. They follow a strict legal hierarchy, one most depositors have never seen, yet one that determines exactly who absorbs the shock and who walks away untouched. The largest losers are always the same individuals and businesses holding more than $250,000 in a single account. Small business owners with operating cash for payroll, inventory, or quarterly taxes suddenly discover that half their working capital has vanished. Retirees who recently downsized or sold a home watch savings carefully built over 30 years cut by 20 to 40%. Families with inheritance funds, legal settlements, or proceeds from a property sale wake up to account balances that no longer match reality. These are not speculative investors. These are ordinary citizens who simply trusted the banking system. The second tier of casualties includes depositors who believed they were diversified because they held multiple accounts but all inside the same bank. FDIC insurance applies per depositor, per institution, per ownership category. It does not matter how many accounts you have. If they share the same legal owner within the same bank, everything over $250,000 is exposed. Meanwhile, the survivors follow a predictable pattern. Individuals with less than $250,000 in insured accounts see no losses, though their access may be delayed. Families who spread deposits across multiple banks remain fully protected, each institution providing a separate insurance limit. Those who intentionally structured accounts into different ownership categories, individual joint trust retirement can hold far more than $250,000 safely. And then there are the true outliers, people who keep a portion of their wealth in hard assets, credit unions, or self-custody digital money. They are not part of the bail-in at all because their capital is outside the banking system. In every historical case, the pattern repeats: the unprepared suffer the most, the moderately cautious survive, and the strategically positioned emerge with their finances intact. When the next bail-in happens, the lines will be drawn the same way. Protecting yourself from a bail-in is not complicated, but it requires action before the crisis, not during it. The rules are clear, the mechanisms are public, and the loopholes are legal. What matters is whether you use them while time remains. The first step is strategic distribution. FDIC insurance covers $250,000 per depositor, per institution, per ownership category. That means one individual account at Bank A is insured up to $250,000, while another individual account at Bank B is insured separately. A joint account doubles the protection. A trust account multiplies it further. By spreading money across banks and account types, you can transform what seems like limited insurance into layered comprehensive coverage. The second step is institutional diversification. Most bail-in risk concentrates in large systemically important banks, those entangled in derivatives, commercial real estate loans, and global liquidity networks. Smaller community banks and credit unions, particularly those insured by the NCUA, generally carry lower exposure to high-risk assets. Moving a portion of your deposits to conservative institutions reduces the probability of being caught inside a resolution event. The third step is reducing banking dependence. A modest emergency reserve held outside the financial system secured in a fireproof safe ensures liquidity when ATMs fail and online banking freezes. This is not about distrust. It is about resilience. Physical cash becomes essential the moment digital access disappears. The fourth step is shifting surplus capital into hard assets. Gold, silver, productive land, and self-custodied digital assets cannot be haircut by a bank because they do not sit on a bank's balance sheet. They are not deposits. They are property. In every country that has experienced a bail-in, holders of real assets avoided the losses entirely. The fifth step is vigilance. Bank failures never happen out of nowhere. They begin with rising delinquency reports, sudden liquidity injections, unusual withdrawals, and regulatory warnings. By monitoring these signals, you can move early, long before the freeze. A bail-in is devastating only for those who are unprepared. For everyone else, it is a storm you can watch safely from the shore, protected by structure, strategy, and foresight. The system will not protect your money, but you can. The timeline for a systemic banking event is no longer theoretical. It is emerging piece by piece, visible to anyone willing to look past headlines and examine the underlying structure. In 2025, the stress fractures began to form commercial real estate defaults, rising regional banks quietly tightening lending liquidity, thinning across bond markets, and interest expenses consuming more of the federal budget than ever before. These were not random data points. They were early tremors. By 2026, those tremors deepen into cracks. Refinancing windows close for weak borrowers, several mid-sized institutions report growing losses, and the first emergency weekend resolution quietly takes place, framed as an isolated incident but functioning as a rehearsal. Confidence weakens, but the system holds. Then comes 2027, the year when multiple stresses converge. A major derivative counterparty fails. A cluster of regional banks with heavy real estate exposure announces insolvency. Treasury yields spike after a disappointing debt auction, forcing mark-to-market losses across the banking sector. Withdrawals accelerate, liquidity evaporates. Suddenly, the machinery built after 2008 is engaged. Resolution authority is invoked. Accounts are frozen. Haircuts are calculated. The first true bail-in of the modern American era unfolds over a single weekend. By 2028, the event is global. Europe activates its BRRD protocols. Canada triggers its CDIC bail-in rules. The UK deploys its special resolution regime. Markets convulse, governments reassure, and citizens learn a lesson that history has taught for a century. But modern society has forgotten the banking system does not exist to protect you. It exists to protect itself. This warning is not a prediction of doom. It is a timeline of probability based on law, precedent, and structural mathematics. The window to prepare is open, but not indefinitely. When you step back and examine the full picture, the legal framework, the historical precedents, the structural fragility, and the global policy shift, one truth becomes impossible to ignore. The next major banking crisis will not be met with bailouts. It will be met with bail-ins. The mechanism is written into law. The regulators have rehearsed it. Other nations have already executed it. And the financial pressures building beneath the surface guarantee that the system will eventually need to use it. The question is not whether the government will take depositor money to stabilize failing banks. The question is whether your money will still be inside the system when that moment arrives. Preparation is not panic. It is prudence. Systems fail. Banks restructure. Markets reset. Those outcomes cannot be controlled, but where you stand when they happen, that is a choice. If this breakdown opened your eyes to a threat you never knew existed, if you now understand that banking safety is conditional, not absolute, then stay with this channel. Over the coming months and years, we will track every signal, every regulatory shift, every stress point inside the financial system. You will not be caught by surprise. You will not be frozen out. You will be prepared, informed, and positioned long before the weekend everyone else wakes up too late.